What happens when you give a regular guy a millionaire's investment strategy and just 90 days to make it work? I decided to find out. No lottery wins, no rich uncles, just real money, smart plays, and a whole lot of risk. From crypto swings to blue-chip stocks, high-yield assets to high-stakes lessons. This is what happened when I invested like a millionaire for 90 days. Today we will talk about I invested like a millionaire for 90 days. Here's what happened. So before we start, make sure to hit the like button and subscribe to my channel. 1. Why I chose to try this. I've always been curious about how the wealthy approach investing. Unlike the average investor, millionaires often have access to financial advisors, exclusive investment opportunities, and a mindset shaped by risk tolerance and long-term vision. For 90 days, I decided to follow strategies commonly employed by millionaires: asset diversification, minimal emotional trading, and exposure to alternative investments. I set aside $50,000, significant, but only a fraction of a typical millionaire's portfolio. My plan wasn't to mimic high-risk moves like hedge fund leverage, but to replicate the strategic allocation and behavioral patterns of wealthy investors. I pored over financial publications, millionaire portfolio breakdowns, and spoke to advisors. This wasn't about becoming rich overnight. It was about discipline, learning, and mirroring proven tactics. I used a hybrid model: 60% traditional stocks and bonds, 20% alternatives like real estate and crypto, and 20% cash equivalents. Here's a detailed breakdown of how that experience played out. 2. Setting up the portfolio. Constructing the portfolio was more intricate than I expected. I didn't just buy stocks. I mimicked how millionaires build core and satellite strategies. The core of my portfolio, around 40%, was allocated to low-cost index funds like the S&P 500, via VOO, and Total World Stock Funds, BTE. Another 20% went into municipal bonds and Treasury inflation-protected securities, Type S, instruments favored by the wealthy for stability and tax advantages. For the alternative slice, I used Fundrise for real estate exposure, purchased 0.5 BTC, and dipped into Ethereum and Solana for a tech-forward edge. I even explored fractional art investment through Masterworks. The final 20% was in high-yield savings and short-term T-bills for liquidity. I balanced assets monthly and reviewed analytics weekly, just like advisors recommend. I also avoided frequent trading, a millionaire trade. This approach prioritized patience over timing the market. The setup took 2 weeks, but felt methodical and intentional. 3. Mindset shift, thinking long-term. One of the first major changes was psychological. Millionaires don't chase short-term gains. They think in decades, not days. I had to rewire my brain to not check daily movements obsessively. I learned to accept red days without panic. I adopted a mental framework borrowed from Ray Dalio and Warren Buffett. Volatility is normal, and downturns are opportunities. During a brief market dip in week 5, I resisted the urge to sell and reminded myself this was about principles, not panic. I journaled weekly to track my emotions and decisions, noting how stress subsided over time. I also learned the value of information diet, limiting exposure to sensationalist news, and relying instead on quarterly earnings reports, balance sheets, and macro trends. That discipline was surprisingly freeing. I felt less anxious and more confident. The long-term mindset changed not only how I invested but also how I approached risk in other areas of life. 4. Alternative investments beyond stocks. Millionaires don't just invest in stocks and bonds. They embrace alternative assets. I allocated 20% of my portfolio to this space. Real estate was first. Through Fundrise, I invested in EITs, targeting apartment complexes and logistics centers. My dashboard updated quarterly, and I began to appreciate the slow compounding nature of real estate. Then came crypto. I already owned Bitcoin, but I treated it now like digital gold, something to hold long-term, not trade. I also dabbled in NFTs, not to flip them, but to understand the asset class. Finally, I tested Masterworks, buying shares in a Banksy painting. I realized that alternatives require patience and faith in different timeframes. 5. Advisors, algorithms, and tools. Millionaires often leverage professional advice and sophisticated tools. While I didn't have a personal wealth manager, I did use robo-advisors like Wealthfront and subscribed to premium financial analytics platforms. These offered algorithm-based rebalancing, tax loss harvesting, and detailed portfolio simulations. I also use services like Morningstar and iCharts to assess investment quality. I even scheduled 2 consultations with fee-only fiduciary advisors to review my strategy. Their advice? Stay the course, reduce overlap between funds, and consider tax efficiency. I also learned about direct indexing, a tax-advantaged strategy that wealthy investors use to capture tax losses while maintaining market exposure. Another surprising benefit: my net worth tracking improved dramatically. Using tools like Personal Capital, I reviewed assets, liabilities, and cash flow weekly. 6. The power of patience. Around day 45, I hit a wall. The market was sideways, my crypto holdings dipped 12%, and my real estate dashboard hadn't changed. I questioned whether this slow, disciplined strategy was effective. But then I reviewed historical data and found that the biggest long-term returns came not from timing, but from time in the market. This is something the wealthy understand deeply. I held firm, resisted rebalancing emotionally, and focused instead on increasing my knowledge. I took courses on investment philosophy, read Howard Marks memos, and explored past financial crises. The more I learned, the calmer I felt. Millionaires value financial literacy and patience over reaction. 7. Passive income and compounding. I was surprised how many millionaire portfolios emphasize passive income, not just capital appreciation. My dividend-paying ETFs returned modest but consistent income. My real estate investments paid quarterly distributions. Even my high-yield cash account beat inflation. This steady inflow added psychological confidence and underscored a major difference in how the rich build wealth. They chase cash flow, not just paper gains. I tracked all sources in a spreadsheet and reinvested every dollar automatically. Watching those reinvestments stack up felt like progress, even when portfolio value fluctuated. I also studied compound interest closely. Using simple compounding calculators, I projected my portfolio's 10-year future if I continued the same strategy. The numbers shocked me, not because they were flashy, but because they revealed the exponential power of consistency. 8. What I've learned about risk. Before this experiment, I thought risk meant volatility. But investing like a millionaire redefined the concept for me. True risk, I learned, is not knowing what you own, or worse, making emotional decisions without a plan. I started using risk profiling tools and scenario analyses to test how my portfolio might perform in recessions, high-interest environments, or bull runs. I realized that most millionaires build for resilience, not speed. They expect corrections. They don't obsess over daily market movements. They manage risk not just by diversification but by liquidity planning, tax strategies, and scenario modeling. I adopted similar habits. I created an emergency fund, stopped overtrading, and even wrote an investment policy statement outlining my core principles. The result? I slept better. My risk tolerance became an asset, not a liability. This reframing was among the most valuable lessons of the 90 days. Risk isn't something to fear, but to understand, shape, and manage. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.